We begin this hour with stocks rising, fueled by big tech and easing trade tensions. Jim Bianco of Bianco Research writing the real AI bubble is pessimism about not owning enough of it. AI stocks are already at a record concentration for one theme, 48% of the S&P 500. Jim joins us now for more. Jim, welcome to the program, buddy. Are you suggesting we haven't seen capitulation yet?
No, I don't think we have, but we're getting very close to it. It might have actually process might have begun last week with the earnings reports that we saw from these companies. Now that I've said that, that capitulation process could take several months, or it could take a couple of weeks. But there seems to be a movement towards everybody's got to get into AI and just full speed ahead right now.
What does the rest of the market, Jim, say about the broader U.S. economy? This came from Jonathan Krinsky of BTIG, that a record high we hit on Wednesday just last week. 33% of the components of the S&P down 20% or more from a 52-week high. What tells you more about the broader economy?
I think the rest of the market does, and you're right. If you were to exclude the AI stocks, and we do an exercise of it like a lot of other people do, you've got maybe the rest of the non-AI stock market up 6, 7, or 8% for the year. And to put that into perspective, the bond market, the Bloomberg Aggregate Index, is up 7% for the year. So the rest of the market is just performing in line with the bond market right now. And it's showing you that the economy is, okay. 7% return after 11 months is not necessarily a...
Jim Bianco of Bianco Research. It looks like we've got a technical issue with that connection. When we re-establish that, we'll come back to Jim in a couple of minutes' time. We call it earnings season, Lisa. I call it cherry-picking season. Pick a story, tell a story, pick a name, whatever you want. I'm going to pick Chipotle last week. That tells you a lot, I think, about why the people who aren't concerned about inflation are more worried about the labour market. Chipotle basically telling you the consumer slowdown has affected the business and we don't plan to offset higher costs with higher prices. That's Chipotle. They've got their own problems, I know, but if you were to cherry pick one story to support the Governor Myron argument right now for lower interest rates, that would probably be it.
Yeah, Chipotle, is it the Chipotle economy or is it the Delta economy? I would give you another one, eBay. Lori Calvasina came out with a quote that was from their earnings call saying that there were greater orders of used parts for people who can't afford to replace an actual item that is a big ticket item. There is a sense around the margins, there is a real deterioration around consumer discretionary and consumer staples, apart from the high-end luxury, that has caused a lot of concern. And it's the reason why Torsten Slok last week said there is a K-shaped market. It is not just an economy where you see the Mag 7 gaining in profits and you see the rest of them not so much.
Jim Bianco, we've re-established that connection. Jim, welcome back into the show. Let's just build on what Lisa and I were talking about. The Chipotle economy, the Delta Airlines economy. Which economy should this Federal Reserve be setting interest rates for? The Chipotles of this world or Delta Airlines? Because one means rate cuts and the other means something completely different.
It does. And I think the Fed has to be careful here because they operate under the financial channel. And the short answer you'll hear is stocks are at an all-time high, housing's at an all-time high, M2's at an all-time high, gold's at an all-time high, crypto's near an all-time high. What problem are you trying to fix with the financial channel? So if they want to cut rates, they're just helping the top 10% or the top end of the K by pushing markets up. It's not necessarily going to help the bottom of the K. The bottom of the K needs more in terms of production increases and maybe changes in demand in order to help fix that. So necessarily cutting interest rates to help push the stock market to new highs and push maybe M2 up higher and to push housing prices higher is not going to definitely help the broad masses of the economy.
That said, Jim, one argument against that is that actually cutting rates will help people with auto loans or student loans or some of these short-term lending instruments that have been the most onerous for the lower end of the K-shape. I mean, do you just reject that? You say that the bang isn't worth the buck just based on the fact that it will inflate something of a bubble?
If it works, because if you go back to last year's rate cuts in September of 24, after the Fed started cutting rates, long-term interest rates went up, and there was no relief in any of those other loans because they're set at market rates. And the reason was the market looked at those rate cuts, was worried that it was going to be inflationary, and interest rates rose. If the market was to see a series of aggressive rate cuts right now as potentially inflationary, you could see a repeat of that where long-term interest rates will go up. It's not a given if the Fed cuts rates that long-term interest rates will follow lower. Last year is a great example of that.
Jim, does it concern you that a lot of the big tech names are issuing more debt, that there is leverage starting to creep into this tech-driven cycle in a way that really hadn't been the case a couple of years ago?
Yeah, it does, because they're starting to, imply that the build-outs that they want to do and the impact on the economy is not going to be funded out of cash flow like they were telling us literally earlier this year, but that they're going to start borrowing. And that's going to put more pressure on them to see a lot of this AI and a lot of these build-outs produce profits and produce cash flow. Right now, if they were funding it out of their own profit operations and not borrowing, they'd have a little bit more runway in waiting until things were profitable. So it's going to compress this cycle that they're going to have to start making money much sooner than they maybe thought a few months ago.
So there are two sides of this. On one hand, you could say this actually injects more discipline on these companies. And we've seen that with Meta over the past week after their earnings report and people were concerned about their spending. You could flip this on its head and say, well, if the Fed cuts rates, it will only fuel the bubble that much more and make people sort of more accepting of any kind of leverage. Which do you see as the more likely scenario?
I'm more in the latter camp. I know Chairman Powell said at his press conference on Wednesday last week that all of this AI funding was not interest rate sensitive. Yeah, that's true. No one at Meta is sitting around worrying about what the interest rate they're going to get on their 30 billion bonds are. But the banks and the hedge funds and everybody else that's getting cheap money is desperate for something with yield, and they're willing to buy something like this. So the Fed rate cuts do, at least on a secondary measure, help push these things higher. And I think that this is going to be really important as we move forward, is that this easing of financial conditions is going to have a second order effect in the economy, especially the AI economy.
Jim, John mentioned at the top of the show that it's day 34 of the government shutdown. How important do you think is it for the government to open and to get the data back out and flowing for this Federal Reserve to cut in December?
I mean, it's actually more important for the Federal Reserve than it is for like the rest of Wall Street, only because there's plenty of private data out there to give us an idea of where the economy is going. Earnings last week, we had almost half the S&P report. We've got, something like 50 or 60 S&P companies reporting this week. So we've got a pretty good idea where the economy is. The problem is the Fed works on models based on government data, and they're not getting that data. So it's more of an issue for them than it is an issue for, say, investors saying, do we really have a good handle of where the economy is?
Jim, are you basically saying that you don't need BLS data anymore? What if we never get it again? Would this market be fine?
I mean, you could adjust for it. You've already seen ADP come out with a new pulse report that's putting out weekly numbers. There are ways that the market will adjust and fill that gap if we never were to get BLS data before. Now that I've said that, we are going to get BLS data before again, because this government shutdown will end. I know it seems like it's going to go forever, but it will end at some point. Now, we may not get October data. There might be a permanent hole in the data series, but we will start getting data again.
Well, Jim, I think Annmarie gets to something important, though. I think the key issue right now for a lot of people is this equity market is completely decoupled from payrolls growth anyway. So even if it comes back, how instructive will it actually be for the direction of equity markets?
Well, I think it would be instructive for the rest of the non-AI equity markets, because they still operate on cash flow profits, outlook, and strategy, and all of those other things, and that the state of the economy will matter a lot more for them. But the AI economy is operating on something completely different. I'll give you one quick example. Look at the Mag 7. Which is the worst performer in the Mag 7? It's Apple. And what does Apple not have? An AI strategy. It seems like the market is punishing anybody who decides not to play in AI, like Apple, and wants everybody to play in this game. And it's so everybody's got a chance, has to play. So the AI stocks are going to keep playing until at one point there's the demand for profits. But the rest of the economy is definitely going to need to see some data, and it's going to need to see some clues as to where the economy's going.
Hey, Jim, appreciate it. As always, Jim Bianco there of Bianco Research on the latest moves. Just to sit on tech, Lisa.